What's up, it's Ron. You ever stare at a crypto chart and wonder what do these lines actually mean and how do people trade off of them? Well, in this series, I'm breaking down 5 of the best crypto indicators for beginners, starting with one that changed my trading game. Using indicators in day trading or swing trading is super important because it'll help you make smarter, more informed decisions instead of just guessing. They show me things like momentum, trends, support and resistance levels. Basically, they help me understand what the market is doing and where it might go next. Indicators don't guarantee profits, nothing does, but they give you an edge. And in trading, having an edge is everything. Without them, you're just guessing. With them, I'm making calculated moves. And quick disclaimer, this isn't financial advice, so always do your own research. And hey, if you appreciate insights like this, please hit the like button. It really helps push this video in front of beginners trying to learn how to trade crypto and helps your boy out and is super appreciated. Moving averages completely changed my trading game, and once I learned how to read them, everything clicked. They help me filter out the noise and really focus on what really matters: trend, momentum, and clean entries. So what are moving averages and how do I use them? A moving average is simply an average price of a coin over a certain number of candles or time periods. It's a line that illustrates a smoothed out price action so that you can clearly see the overall trend, whether the market is moving up, down, or sideways. And the main reason that it works is because a lot of traders are watching these exact levels. So they work because of how many eyes are on them. The price tends to bounce or reject off these moving averages because it's kind of like a self-fulfilling prophecy. Everyone's reacting to the same signals. Real quick, whenever I talk about indicators in trading, please keep in mind that time frame matters. So on a chart, I personally use these: the 15-minute, the 1 hour, the 4 hour, and the daily charts, depending on how fast I'm trading. Now, if you're scalping, stick to lower time frames, and if you're swing trading, the 4 hour or the daily chart will be better. But the principles are the same across the board. So moving averages on higher time frames like the 4 hour and the daily are a lot stronger and more reliable than those on lower time frames. Why? Well, because they reflect way more data in market participation. For example, say you have a 200 moving average on a daily chart. That is pulling from 200 full days of price action, which gives you a much clearer picture of the overall trend. And don't worry, I'll explain this in full detail throughout the video. On the flip side, a 200 moving average on a 1-minute chart is just using the last couple of hours of movement or the last 200 minutes. And those small moves can get super noisy and manipulated, especially in crypto. Price can whip around above and below moving averages on lower time frames all day long and not mean anything. So when I see price break above or below a major moving average on the 4 hour or the daily, that gets my attention way more. And that's what the big dogs, institutions, whales, and serious swing traders are watching. So here's how I think of it: lower time frames, speed, precision, but more noise. Higher time frames, slower, but way more reliable. That's why I always try to zoom out and check the moving averages on higher time frames before entering my trade. If everything lines up across multiple time frames, that's where the real confidence comes in. Instead of reacting emotionally to every spike or dip, moving averages help me stay focused on the bigger picture. Okay, now there are simple and exponential moving averages. The only difference is the weight that it puts on the most recent price action. So for example, a moving average on a SMA or a simple moving average is spread across the entire period. And for the exponential moving average, or EMA, is what you're going to hear in this video, it puts more weight on the recent price actions and therefore is reacting faster than the simple moving average. It's up to you on which one you prefer. In this video, we will be using the EMA. We will use the 9, the 20, the 50, and the 200. Each of these will serve a different purpose in my trading strategy. So let's go ahead and jump into the chart. Let's go ahead and start with the 9 EMA first. The 9 EMA reacts very quickly to price changes, so it helps to see the momentum in real time. If the price is above the 9 EMA and holding, it's often a sign of a strong short-term bullish momentum. Now, if it's below, it can show weakness and shift to the downside. So right here, I have the ETH USDT chart. What we want to do is go ahead and activate the 9 EMA. Right now, we're on the daily chart. So what we want to do is go ahead and zoom in so you guys can get a better look at what's happening here. For example, right here, let's go ahead and and get my marker. You see it broke. It was bearish for a moment. It came up and then it retested the 9 EMA. Same here. It broke, came up, started riding along. The 9 EMA is a resistance level. So you can kind of see that happening there. And so this is on the daily. Let's look at the 15. All right, right here you see it kind of went over. Let's go ahead and draw that in. Under. It's kind of riding along, but then it drops bearish for a moment. Then it comes and it taps and rides along this 9 EMA. Remember, this is the fast, but a little more noise, right? This is what we spoke about earlier. So this is the 9 EMA. Let's go ahead and look at the 20. All right, so you notice with the 20, there's a little bit less noise than you saw with the 9. The 20 EMA, or the 20 moving average, sits right between the fast reacting 9 and the more stable 50, which we'll look at here in just a moment. It's kind of like the middle ground, and it's super helpful for both trend confirmation and pullback entries. When I'm trading, I use a 20 EMA to spot the healthy pullbacks in the uptrend. If the price pulls back to the 20 EMA and bounces, then it's often a great entry point for a continuation move. It's also helpful for spotting consolidation. If the price starts riding along that 20 moving average sideways, then it usually tells me that the market is taking a breather before its next move. So you could kind of see this very clearly happening. You'll notice how it's bouncing off the 20 EMA. Then when it breaks through, it goes lower and it starts to kind of retest. It broke through, came back, started riding the 20, comes here, rides a little bit, falls under, pulls back towards the 20. And so you'll notice that you can see a little bit better of a picture when you're dealing with the 20. It's going to remove the drawings. Let's look at the daily. All right, so this gives us an even better picture. It looks like it broke under this 20, comes back up, rides along it, then dips under, pulls back to the 20 EMA. And you see that it continues to kind of do that. And the 20 EMA is kind of looking like resistance. Over here, it's support. All right, so what we want to do now is it's going to remove the drawings. And I'm just going to layer this 9 EMA on top so you can kind of see. Something to look at is if you are day trading and you see the lower time frame cross the 20 or the larger time frame, that it turns bearish. If you see it cross back, it turns bullish. Cross back, bearish. Another good strategy when using these moving averages. Let's go ahead and close these out. Let's jump into the next one, which is the 50 EMA. Now the 50 EMA is a midterm trend indicator. It doesn't react as fast as a 9, but it gives me a sense of whether we're in a strong upward or downward trend. If the price stays above the 50, that usually means buyers are in control. When it breaks down, it might be a warning of a deeper pullback or reversal. This is my go-to for confirming if a trend has real strength behind it. I use the 50 and the 200 EMA a lot. So let's go and turn that one on. Now let's see what we can spot here. Let's grab our marker. We see this incredible bullish upward move way above the 50, comes back, kind of rides along it, comes back up, breaks under. Now it becomes resistance. It's having trouble breaking the resistance, and then boom, it becomes bearish. Let's go ahead and go to the 15 minute. Rides along, goes bearish, breaks through, becomes support, and then you'll see that. Let's go to the 4-hour chart. All right, comes here, tests the resistance, becomes support, breaks through, then becomes resistance. That is the 50 EMA, watched by a lot of traders. Let's go ahead and cut that off. Let's look at the next one, probably the most important one. This one's a big deal, the 200 EMA, which is watched by tons of traders and acts like a line in the sand. When the price is above the 200, we're generally in a long upward trend. When it's below, we're likely in a major downtrend. Let's go ahead and turn this on. Just like we said, when it's above it, upward trend. When it breaks below it, comes downward trend. Huge moving average to make sure that you guys are utilizing. Typically, you'll notice when something breaks the 50 EMA, it kind of tends to want to gravitate towards the 200 EMA. And so it's just great when you use them together. Let's go ahead and add the 50 EMA now. We'll see that when it breaks through the support of that 50 EMA, you see that it tries to touch the 200 and then it rejected here and then it became bearish. One thing I really respect about the 200 EMA a lot is that it's just not a number. It's a major support and resistance that institutions and big traders pay attention to. I trust the 200 EMA because the whales do too. When you use all of these things together, it tells a story. The 9 tells me what's happening right now. The 50 shows me the short to mid-term trend, and the 200 gives me the bigger picture. Using these moving averages is only one tool in the arsenal of indicators, but it is the first one that I would recommend mastering. It can help you avoid fake outs and know when to enter and exit. They don't predict the future, but they make reading the market a lot easier. So let's go ahead, and we kind of touched on this, but let's talk about when the EMA intersects another EMA. You may have heard of the golden cross or the bullish cross. Now this is when a smaller EMA like the 9 or the 20 crosses above a larger EMA like the 50 or the 200. This signals that buyers are gaining control and the momentum is shifting bullish. Now if this happens on a strong uptrend, I look for long entries, especially to retest some of the EMAs. So for example, if the 9 EMA crosses above the 20 or the 50, short-term momentum is turning bullish. If the 50 EMA crosses above the 200, which is the golden cross, the 50 crossing over the 200, that's strong confirmation for a long-term uptrend. Right here, if we look at the 50 and the 200 like we did a moment ago, it crossed. And so what happened after that? It turned extremely bullish. It's very important to look for this golden cross. When you see this 50 cross the 200 above, you'll notice this happening. You might notice it, right? We can't predict the market, but when you see it crossing under, it becomes bearish. We'll talk about that here now. All right, now for the bearish movement, EMAs like the 9 or the 20, when they cross below the larger ones like the 50 or the 200, sellers are taking control and the momentum is shifting bearish. If this happens on a downtrend, like we're seeing right here, I look for short positions or short opportunities, and I really exit from my long positions if I have any open. When the 9 EMA crosses below the 20 or the 50, short-term momentum is turning bearish. When that 50 crosses below that 200 moving average, then we see strong confirmation of a downtrend. And again, you can see that here in this Ethereum chart. It's a long, look at that downtrend right there. So that's an incredible short entry. If you were to trade this and you waited, you saw this cross, it did this, you wait for confirmation, it retested that 50, you went ahead and entered your short position here, did a stop loss above that 200, you could have made a lot of money on this type of trade. This is also known as the death cross. Not all of these crosses mean a guaranteed trend shift. Sometimes you have price fake outs with these crosses and then it just reverses back. But this is why you got to make sure you add a stop loss. This is why I combine the EMA crosses with other confirmations like volume, support and resistance levels on top of the other 4 indicators that we'll talk about in this series. Basically, the idea is this. Markets don't move in straight lines. When crypto goes up or down, it usually will pull back a bit before continuing. Fibonacci retracements help us predict where that pullback might stop. It shows us key zones where price might bounce, giving you clean opportunities to enter, exit, and protect your position. Now, it's based on something called the Fibonacci sequence. We're not going to nerd out here, don't worry, but what matters are the main levels: 0.236, 0.382, 0.5, 0.618, 0.786. These just represent how much the previous move has retraced. In other words, how much of the move price is giving back before it potentially continues. And this is what we will go over today and apply it to trading. It can help us figure out where to buy the dip, where to set our stop losses, where to take profit. And just like the moving averages, which we broke down in the last video, Fibonacci levels often become self-fulfilling zones. Why? Well, because so many other traders use them. The market tends to react around these areas, and that's why it works. All right, so first things first, I always start by identifying the trend. This is super important. I ask myself, are we in an uptrend or a downtrend? If the market is making higher highs and higher lows, I know that I'm in an uptrend. Now, if the market is making lower highs and lower lows, then this tells me that we're in a downtrend. Okay, so then why does this matter? Because trading with the trend gives me a much better chance of success. Trying to trade against the trend is like swimming upstream. It's possible, but way harder and riskier. Once I figured out the trend, that's when I bring in the Fibonacci retracement tool. I use it to find clean entry points that line up with the overall direction of the market. In an uptrend, I look for the price to pull back to the key fib levels, 0.5 or 0.618, the golden zone, and then bounce. that's usually a good spot to get in and ride the next wave up. And in a downtrend, I do the same thing, but in reverse. I wait for the price to pull back and then continue dropping. This process keeps me patient and disciplined instead of just chasing the price or making random trades. I wait for a high probability setups that make sense. It's all about working with the market and not against it. Now we want to look at the levels that actually matter. When you draw your fib retracement tool from the swing low to the high in an uptrend, or the high to the low in a downtrend, you see levels like this: 0, 0.236, 0.382, 0.5, 0.618, 0.786, and 1. Between 0.5 and 0.618 is what we call the golden zone. It is very well respected, and it's something that you really want to pay attention to. Pretty much your whole reason for using the Fibonacci tool in general. So out of all of them, the 0.618, the golden ratio, is crazy powerful. That's the level that I pay the most attention to. These Fibonacci levels can seem confusing, but they're just percentages. For example, 0.5 is 50%. 0.618 is 61.8%. 0.786 is 78.6%. 1 is 100%. These are all percentages. It's where the market often pulls back before resuming the trend. A lot of big players react to this zone. So when price hits it, I'm watching closely for my entries. And just like we talked about with moving averages, the higher the time frame, the more weight that these levels carry. So a fib retracement on a 4-hour or a daily chart is going to be way more reliable than the one on a minute chart where the price is bouncing around like crazy. Here's how I use it. Short time frames like 15-minute or 1 hour for scalps and quick plays. Higher time frames, 4-hour or the daily, can be for stronger support, resistance, and swing setups. Same rules apply as before. Lower time frames, speed and noise. Higher time frames, clarity and confirmation. Now let's look at Sol USD on the daily chart. At the top, we can change our time frame to fit our trading style, whether you're scalping, day trading, or swing trading. We will use the daily chart to illustrate how we're going to use the fib retracement, and we'll go back to look at past examples in this chart and draw out our fib lines so that we can see how the chart reacted. Now there's a lot of time frames to choose from. Remember, I said for me personally, I use the 1 day, the 4-hour, the 1 hour, and the 15-minute. But for this example, we're going to use the 1 day. First, I'll go ahead and reset my chart view, remove my drawings. So let's go ahead and look for somewhere in time where there's a general uptrend, and we'll go ahead and try to identify a pullback and see how the fib retracement tool helped us in that way. So let's look for a shift in trend. All right, so right here we see that there is clear downtrend. Right here is the accumulation and then uptrend. So maybe we check here. So I'm gonna go ahead and delete the drawings. All right, now we're looking at this section. We know it's in an uptrend because you'll see higher lows and higher highs. And if you kind of look at this, I'll draw that out for you as well. You'll see higher lows, you'll see higher highs. All right, so I'll remove drawing. That's how I was able to identify uptrend or downtrend. Now I'm gonna draw the fib retracement lines. In TradingView, you just go right here, click on that, select fib retracement, and now you're ready to draw. Let's just draw from this down wick to this up wick. Zoom in a little bit here. And what I want to do for you as well is I want to draw the golden pocket, or that golden zone, which is between the 50% and the 0.618 or 61.8%. This is known as the golden zone. All right, so what do we notice here? We notice that the price action, once it goes up and we're looking for an entry for our pullback so that we can enter a long, we'll see that it comes into this golden zone and then it moves back up. That's a short trade right there, but it did go in the right direction, went back uptrend. Now it kind of comes down here and hopefully we took some profit. But as you can see, when it got into this golden pocket, it did a reversal. That's typically why people use fib retracements as point of entry so that you can enter on these dips, whether you're shorting or you're going long. This is why the tool is used. Now we can go ahead and try it again. Let me go ahead and delete these drawings. And so now we see a pullback and we see this move right here. So say we're trading this move, we would have drew our lines from that bottom wick to this top wick right there. I'm just moving it across so that we can see everything closely. Let me zoom in. Let's draw our golden zone right there. And so what do we notice here? We notice that when it makes this move, it comes back. It taps this golden zone and it does this very parabolic move. That would have been a great entry. That is a huge move. That is incredible. The reason I drew it here is because it made this move. It started pulling back. So I looked for a low point. Now let's say we drew it right there. Let's say we caught it on this move right here. So then all we would do is draw it from this candle to this candle, and let's see if it worked. There it goes. It tapped our golden zone and it made this parabolic move. Let's say you just caught it right here on this pullback and it started coming down like this, but you don't know where to enter. You go ahead and draw it right there. Here's the top wick, here's the bottom wick. Let's zoom in. Look at that. Perfect entry. Comes into this golden zone and makes this reversal that is absolutely beautiful. This will make for better setups, cleaner entries, tighter stop losses. It's an overall top 5 tools I think you should utilize when you are trading. It's absolutely essential. And then what we can do is let's go ahead and look at some short positions. Now, currently right now in the market, it's seeming a bit bullish, so I really don't know if this is going to continue to dip more, but for the sake of this example, let's go ahead and see where we think it's going to go. Now I'm drawing from the top wick now to the bottom wick because we're in a downtrend. Now, if I think we're going to continue to go down, this is what I would do. Comes here, rebounds, enters our golden pocket, kind of steps out of it, and now it's retracing. If you did enter somewhere around here, you may have gotten stopped out right here if you had a really tight stop loss. But say your stop loss was right here or even a little bit higher, you wouldn't have been stopped out. You would still be in the trade. Now, today is a very bullish day, so this could be a sign of a reversal happening. We don't really know yet. That's why when you trade, you have to use multiple confluence, or you have to have confluence and have multiple indicators that are signaling the same thing. Fibonacci is just one of them. All right, so now let's take a minute to talk about confluence. I never use fib retracement in isolation. When price pulls back to that golden zone or 0.618 and it lines up with, say, the 200 EMA, for example, or strong support level, that's what I pay attention to. And that's where my sniper entries come from. The more confirmation I have, the more confidence I have in my trade. So you want to make sure to practice this first. Have you ever heard someone say, oh, that's overbought or it's oversold? Well, they may be looking at the RSI signal, but let me tell you that most traders are getting this wrong. They look to enter the trade when these levels reach overbought or oversold, but that's not how we use it. Just like the other indicators that we're talking about in this series, RSI is not a magic fortune cookie, but if you learn how to use it right, it will give you an edge. Let's very quickly get into the basics of RSI so that we can then go into a chart and actually look at real examples and how to use it in trading. RSI stands for Relative Strength Index. Relative means it's comparing to recent ups and downs. Strength means how strong the price moves are. An index means it gives you a score from 0 to 100. It tells you if something might be going up too fast, overbought, or down too fast, oversold. If you use this solely to make your entries, then you will get wrecked. Please keep that in mind. Here is RSI overbought, RSI oversold, and then this is the middle, or the 50. So what do you use RSI for? You need to spot trend strength, timing pullbacks and bounces, confirm your entries and exits, catching divergences, which I'll show you in the chart. When price moves one way, but RSI moves the opposite, it can signal reversal. We'll actually talk about that here in just a second. What RSI is not, it is not perfect. If you just rely on these signals, you will lose. It's not a buy and sell signal by itself. Coins can stay overbought and oversold for a long time, especially when strong trends are happening. So just use it as a clue, not a trigger. In RSI, the 70 means the asset is overbought, 30 oversold. So above 70, maybe it's too high, people might start selling, and below 30, maybe it's too low, people might start buying. It's not a guarantee, it's just a signal to pay attention to. Again, the middle line on the RSI chart is the 50, and here's what that means. 50 is a balance point, not overbought, not oversold. If the RSI is above 50, it means that there's more buying pressure, uptrend. If it's below 50, it just means there's more selling pressure, downtrend. We're going to look at the bullish and bearish divergence. I just want you to kind of get an illustration before we jump into the chart. That's a bullish divergence. That is a bearish divergence. Notice how they're moving in different directions, the price and the RSI. And again, here, the price and the RSI. And here's the chart. I'll actually show you this in great detail in just a moment. Okay, now that we know the basics of RSI, let's go ahead and jump into the chart. Let's Let's look at BTC and turn on RSI. Click on the indicator in the top section and type in RSI. Under technical, select relative strength index. There you go. And then hover over here and select this settings icon. So you can see my settings. It is default, so yours should look like the same thing. The RSI here is in purple. The moving average is in yellow. My input is 14. And my upper and my lower and my middle band are all selected on. So you notice how they disappear. Now they're there. We have it set to upper band 70, lower band 30. Some traders like to adjust this to 80-20, but I like using the levels that I think most other traders are seeing as well. Let's go ahead and hit OK. Now, RSI works differently on different time frames, just like every other indicator. On a 5-minute chart, or let's go a minute. On a minute chart, RSI is moving fast and it's giving a lot of signals, good for day trading. You see it like that. If you switch over to the daily chart, RSI moves a bit slower, but gives stronger signals, better for swing trading. Pro tip, you always want to check indicators on multiple time frames. Now let's just kind of zoom in here, and I just want to show you the overbought and the oversold. This is overbought, 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 oversold, 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 oversold. Right? So you kind of can see where overbought and oversold is. Up here is overbought, down here is oversold. Now, I first like knowing the market sentiment. Are we bearish or bullish? How is the market doing overall? Then you want to add your trend lines and make sure your other indicators are on there, like the moving averages and the other ones that we talk about in this series. Remember to look on the larger time frames and then go down to the smaller time frames as well to see what the RSI is doing. I don't use RSI like most people are teaching. You want to be very smart about how you use it, or you will get blown out. Just to give you an example, right here, RSI is showing overbought, 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 but it's still going up. So you cannot rely on that. What I do is when RSI crosses the moving average, then that's a powerful advanced signal that many traders are overlooking. And divergences as well, which we'll touch on here in a minute, and we will go over both. Just like how price crossing its moving average shows a shift in trend or momentum, the RSI crossing its own moving average shows a momentum shift beneath the surface of the price action. Similar to what I showed you guys with the moving average video, that was the first one in this series. Now, most people use the 9-period moving average on RSI, but you can tweak it based on your own strategy. Let me show you what a bullish RSI moving crossover looks like. So when you see this RSI purple crossing this moving average, you notice that bullish trend happening. This means momentum is picking up and buyers are gaining strength. Generally, it often happens right before price breakout. Now there's bearish RSI crossover as well. So for example, here, the RSI kind of taps the moving average, cuts under that moving average, and then you can see right here, it did this bearish action move, and that would have been a great short entry. So RSI crosses below its moving average, signals weakening momentum, sellers might be taking control, and it could be a sign of a pullback or a trend reversal. So the strategy here is using the crosses along with other signals instead of looking at these over 70 or below 30 signals that you're seeing that can be a false signal. Now let's talk about the RSI divergence. Think of it like this. Price and RSI should usually move together, but if they don't, something is up. Let's go over bullish divergence. Now, a bullish divergence is when a price makes a lower low, but the RSI makes a higher low. Price might be getting ready to move up. So it kind of looks like this. Here you see RSI right there. Price makes a lower low right here, and RSI makes a higher low. So you notice once that happens, you get this exponential move. Same thing goes with the bearish divergence. You'll see here, price makes a higher high, but RSI makes a lower high. And then you see this bearish move right there. RSI is one of the cleanest ways to spot momentum shifts and get early entries. Coming up next, I'm diving into a massively underrated tool. So trust me, you want to see this. Let's talk about the MACD trading indicator. MACD is one of my favorite indicators because it helps me quickly see the strength and direction of a trend. It combines moving averages and momentum in one tool. When the MACD line crosses above or below the signal line, which I'll show you here in just a sec, it gives me a simple buy or sell signal. It works well on any time frame and is super easy to understand, especially for beginners. And since so many traders are using it, the signal often leads to to real price moves. That's why I trust MACD. It gives me clear, powerful insights for better trading decisions. MACD stands for Moving Average Convergence Divergence. It's one of the most respected tools used by traders. This sounded confusing to me when I first started, but it's pretty simple. Convergence means the two moving averages are getting closer together, and divergence means the two moving averages are moving apart. MACD is built using moving averages, which if you haven't seen the first video on moving averages, make sure to watch that as well. Here you can see the MACD line, the signal line, and the circle where you can see where it crosses. And the red and green bars are the histogram, and that is simply the MACD line minus the signal line. So it's the difference. It shows how far the line are apart from each other, and when they become close together, then you'll see that the bars get smaller and it may switch trends. So if you notice, when these two lines come closer together, you'll see that this kind of looks a lot shorter, but when they move farther apart, you notice that the bars get larger. All right, so now that you know some of the basics, let's go ahead and jump into the chart. All right, now we're back in trading view. Here at the top, you want to select indicator. You want to type in MACD. Under technicals, select moving average convergence divergence. There we see it here at the bottom. Let's exit out of that. Let's go ahead and jump into the settings. Hover over the MACD. Click this icon right here. It'll open up the settings. Now, I like to keep it default, but let's look at what is going on here. Let's click on inputs. Now, the MACD line is a 12 EMA and a 26 EMA. And then the signal line is a 9 EMA. Under style, here's the histogram. You can adjust these colors. You can change the bar color type, whatever you want, but I like keeping all the other settings the same. Remember, every other trader is likely using the same settings. That means we're all seeing the same signals, which makes those signals more reliable. If too many people are using different settings, then the signals get less meaningful. So sticking to the default helps me stay on the same page with the rest of the market. All right, let's go ahead and click OK. Right now we're on the BTC on the daily chart. Let's go ahead and click this daily chart. Let's first just click this vertical line. Let's find some areas where they cross like this. So I'm gonna put a vertical line there. Let's look for another one. Let's do this one right here. Okay. So here we see the MACD and the signal line crossing. We see large green bars on the histogram and it tapering off slowly and then becoming bearish. What do we notice that happens when this is occurring at this cross? We see that the market reacts and there's this pullback that becomes slightly bearish. It's not a very strong trend, as you can tell from the bars. So it kind of does this type of move for a little bit, but overall, the MACD did do what it was supposed to do, gave us the right signal. Now, it doesn't always do that, but we aren't only relying on MACD, right? We're looking at all the other indicators in the series. Let's look at this one as well. Not very strong bars either way, but it does cross right here. It does do this bullish move, and then it kind of crosses again. It does a bearish move, and then it crosses again here and does this really bullish move, and you can see how strong this trend is. Remember, when these two signal lines are getting closer together, it's converging. When they're moving apart, it's diverging. Let's look at a shorter time frame. Let's remove the drawings here. Let's reset the chart. All right, now let's take a look at a 15-minute time frame and see what's going on here. Draw some vertical lines. Here's a cross right there. Do another one. Significant cross. And let's look at that cross. Okay, so here we see a cross right about there. You can draw the Fibonacci like we talked about in the past video. You can maybe catch the pullback and ride it up. That would have been a great move. That signal would have worked. Right here we see this bearish move. Very bearish here on the histogram, diverging greatly, but then it intersects right here and it does this move and it actually keeps going. So if you entered down here somewhere, you would have a very good long position, but that MACD worked as well in this scenario. So let's look over here. Probably look for a pullback, but it did not pull back. We see that it crossed and it kept becoming very bullish. That's how we use MACD. It's just one of the indicators that really help us understand the trend and the momentum and what could happen. Very important to learn this and apply it to your trading. The volume profile indicator shows you where the trading activity has happened the most at different price levels, not just over time. Instead of looking at the traditional volume day by day, like the normal volume bars that you see on the chart, volume profile shows you how much volume was traded at each price. This really helps you understand where the buyers and sellers are most interested. And crypto markets are super volatile, so knowing where the big players are in trading kind of gives you an edge. Let's get into it. Let's go ahead and look at the 4 main parts of the volume profile, and after that we will apply it to our trading and see how we can use it to make better trading decisions. The volume profile indicator is essential for both day and swing trading because it shows where most of the buying and selling has occurred at these different price levels, revealing some powerful areas of interest on the chart. Now, these aren't just lines on the chart, they actually reflect real trading activity and the psychology of the market participants, making it a critical zone for making smart entry, exits, and your stop loss decisions. I want to show you this illustration first so you know how the indicator is broken down. So the volume profile indicator will highlight 70% of where most of the trading activity has taken place, and that's in this zone right here. So all of these nodes, and anything above or below represents 15%, which is extreme values of the market profiles and the volume of all the contracts executed in this area. So these are low volume, this is high volume, this is low volume, this is 15%, and this is 70%. And the indicator is going to look something like this. Let's start with the most important part of the indicator is this POC line. Now again, we're going to look at this live here in TradingView in just a moment, but it's important to understand what you're looking at. The POC is a point of control, and this is the price level with the highest trading volume, and it almost acts like a magnet because it represents where the market found the most agreements, the handshake agreement between a buyer and a seller. So price often returns to this point, making it a key level for the reversals and consolidation. So you'll often see a lot of choppy movements around this POC line. Then you have the value area high. This marks the upper boundary of the value area where 70% of the total volume took place. This typically acts as resistance since traders see it as the expensive zone. Price tends to stall or reverse here at the value high unless there's a strong momentum to push higher. Then you have this value area low. The value area low forms the lower boundary of the value area, usually acts as support. Now this is where buyers consider it cheap and they may step in to push this price higher. When price moves outside of this value area, either above the value high or below the value low, it signals that traders are testing whether new value zones will form or if price will return back to balance. And then you have these nodes. You have high volume nodes and low volume nodes. High volume nodes is price levels of lots of trading. So you see this where the POC is. And low volume nodes is areas with very little trading and price can move quickly through these zones. So for example, right here, right there, these are low value nodes. And what makes this tool so powerful is when you see some of these low value nodes, sometimes you can catch a fast move because price typically moves quickly through these zones. A quick recap and we'll jump into the chart. POC, this is a price level where the most volume is traded right here. Think of it as a magnet of the chart where price often returns, and use this to spot high interest zones where price might bounce or stall. The value area high, remember this is a top of the range, 70% of the volume. This is a top of the 70%. It acts as resistance. Price often struggles to break above this level without strong momentum. Then you have the value area low. Again, this is the bottom of the 70% level. This is where price tends to slow down. This acts as support. And if price drops below the value area low, then it may fall further or bounce if buyers step in. All right, let's go ahead and jump into the chart. Right now we're looking at Bitcoin in TradingView on the daily chart. And so what I did now is I come over here, I scroll down to fixed range volume profile. I go ahead and select that. Now you kind of look for a range where you want to see the volume and maybe where the most activity and or handshakes have happened. And so what I typically do is you can draw it from here to here or really wherever you feel like you want to check for the type of volume that's happened. But let's, for the sake of this example, draw from here to here. All right, so we see that the POC is right here, value area high, value area low. Above it is the 15% of the least trading volume, and then same with below it. Now let's take a look at the price movement. So we can see that it wants to work within this range. We notice a lot of wicks that come and touch the value area low in reverse. We notice a lot of choppy action happening where the magnet or the PLC is, and then we see reversals happening at the value area high. Now you do have these candles that break through, sellers take control, comes back, becomes slightly bearish. So here you can actually see the volume profile doing its job, doing what we expect it to do. Let's try another example. Typically I just look for when I see consolidation start happening, and we can kind of see it working. We see that this value area high is acting as resistance and it's reversing. We can see some choppiness happen at the POC, and then we can see the value area low acting as support here in some of the areas. Right here, sellers to control, and then it continued. Go ahead and let's try it on the 15-minute. All right, so here, right now we're on the 15-minute chart. We added it simply by selecting this and drawing it from this candle where I kind of see it doing a pullback to about right here. I want to see what it might do next. And so we kind of see it doing something similar, a little bit of choppiness here by the POC. It acts as resistance on all these candles, dips back down, breaks through resistance, comes back, retests, gets a little choppy, comes back here, and then it tests support. And then it goes back, breaks through, ultimately wanting to come back to the PLC, but we had some bullish action happen right here. Today is very, very bullish. Bitcoin is about to break over 100,000, and I would not add a volume profile in this range. We're looking for a new range to add volume profile in. So this could be the new range. And so this gives you an idea that the most volume traded was actually right here. So most likely we're going to see this current candle come back down to 99,303 and maybe retest support. But today is super bullish, so we're really not sure. I'll keep my stop losses super tight. If we break 100, we might end up going to 105, 106. And overall, I like using this method of checking for volume activity versus the traditional up and down bars. Make sure to open up TradingView, start practicing all the indicators that we talked about in this video. Scroll back to the charts, add the volume profile indicator, the RSI, the MACD, the moving averages. Practice using Fibonacci on pullbacks and just watch how price interacts with what you're seeing. Use this along with market sentiment, news, support and resistance, and boom, you are now better than most traders. You'll start to notice patterns, and that's when everything starts to click. No more random entries, just clean, high probability setups. Make sure you practice each one of these indicators individually and then add on to that, building onto your knowledge. It's better that you understand a few of these indicators very well than a bunch of indicators and not know how to fully use it to your advantage. So if you're serious about making money in crypto, hit that subscribe button, turn on those notifications, and I'll see you in the next one.